Welcome to FX Street Currencies in Play, brought to you in association with Royal Financial Trading. I'm joined by Jeremy Stretch, head of G10 FX at CIBC. How are you today, Jeremy?
Good morning.
Right, it's all go for the pound at the moment for various reasons, all joining at the same time, looking bearish and really not giving us much reason to go long at all.
No, it isn't. I mean, apart from the surprise votes from the MPC last week, where we had 3 members voting for a rate hike, which did confound the market a little, generally the path of least resistance is very much towards the downside as far as sterling is concerned. We have obviously ongoing economic uncertainties in relation to the Brexit process, in relation to the consumer sector dealing with increasing prices. And of course, you overlay that with the political risk as we go into the Queen's speech and the potential, which is not a nominal risk, that Queen's speech, when it comes to the vote in Parliament next week, may struggle to be pushed through. So inherently, it does suggest maintaining very much a short side bias as far as sterling is concerned.
Well, not helpful that having a Queen's speech today and then having the vote on it, your days in the wilderness in the meantime, which is also ratchets up the uncertainty, doesn't it?
Well, indeed it does. And of course, we had the election a couple of weeks ago, and of course that didn't go as the Conservatives planned, quite clearly. Then they immediately started the negotiations with the Democratic Unionist Party, and here we are a couple of weeks on, and we still have no formal agreement. It's true that we still have a week or so to go until the actual formal vote on the Queen's speech, but the longer the disagreement between the two groupings goes on, the greater the risk that the DUP may exercise their political leverage. And of course, if there is an evidence of that, then of course that's going to keep investors very much sitting on the sidelines at best as far as sterling is concerned, and at worst selling into the process.
Okay, let's have a look at the headlines that we've got so far. Quite obvious ones, I think. Pound carnage as Queen's speech overshadowed by potential DUP walkout. And then another story, probably the story of the last 24 hours, oil plunge causes commodity currencies volatility. Oil really hurt, by overproduction in non-OPEC countries, and then also the ongoing dominance or the emergence of the shale producers in the US.
Well, indeed. I mean, that's one of the ongoing themes that we've seen of late, is that resumption of North American output, and of course the cost of production being progressively brought down in both the US and also in Canada, where obviously I have a much greater insight, but even there, where the higher costs of production are evidenced, they are now or were in a position to make money. But also we're seeing production coming back on stream in places like Libya, for example. So that's adding to the supply overhang. And of course, if we're not seeing inventories being worked down, and of course we will get the weekly EIA oil inventory numbers today, but if inventories aren't being worked down, then prices will continue to soften, and we're back at levels that we haven't seen since November, and that is causing a little bit of consternation.
Unwinds all the good work done by OPEC and non-OPEC.
Well, indeed it does. And in a sense,
the price.
I mean, it takes us back to where we were prior to that original OPEC agreement. So, in a sense, the question is, what is it going to take in order to facilitate prices going higher? Does it take even more action from OPEC to try and rein in production? Is that the pressure point the markets are going to try and pursue over the course of the next few days and weeks? Okay,
let's go on to the trade of the day. Pound dollar is being offered due to political uncertainty. Dovish comments from Bank of England's Carney. Immediate support is seen at 125.80, 125.60, which so far held this morning, as we'll see on the Audi chart in a minute. Trade setup, sell top at 125.50. Objective 124.75 to 124.50, and stops at 125.80.90. Risk to reward ratio 2.5. Going on to the intraday chart, we can see the live chart now. So yeah, there you see that the real quite aggressive move down from 127.50, 60. Doesn't look like it's going to go back there in a hurry, does it?
No, it doesn't. It seems very difficult to see what's going to turn around sentiment in sterling in the short term. Obviously, yesterday we saw the market getting hit quite hard in the wake of those comments from Carney. We saw the short sterling strip rallying 5 or 6 beeps quite significantly in the wake of his comments, and that really pushed back against those independent members who were voting for a hike, as I say, in the meeting last week. And of course, we know that one of those hawks has now left the committee. The replacement seems most likely to be much more of a dovish variety. So in a sense,
slightly, yes.
The Chancellor seemingly is making sure that the Bank of England aren't going to be moving towards an aggressive tightening bias anytime soon. So without any rate support and with the other underlying dynamics, it is still a case that sterling downside is remaining in play. And it's kind of interesting if you look at the charts. We're getting back to the sort of levels that we haven't seen since mid-April. And, of course, why is that significant? Well, that's the day when the election was called. So, in a sense, all of that initial sterling impetus after the election was called has almost now been taken out of the market.
Back to square one. How much of this is dollar strength and currencies weakness? Obviously, euro-dollar here struggling to hold above 111. So even this is looking a bit sort of on the back foot, isn't it?
It is. I mean, we have seen investors rebuilding euro positions on a fairly significant basis over the course of the last few weeks. And indeed, the most recent positioning data had euro longs at levels that we haven't seen since 6 years, or seen in 6 years. So in a sense, we've seen a lot of impetus behind the euro. And in a sense, the fact that we couldn't really break up through the 113 threshold, I think, is leaving people a little bit frustrated. And we're starting to see some of those positions sold out now. So we need a fresh reason to add to euro longs in the current environment. We haven't really got that. So I think we're just seeing a little bit of an unwind of some of those holdings. It will be interesting to see whether, when we get the flash PMIs on Friday, whether that's going to be enough to restock the upside bias in euro. And if we are going to see that, we probably will need to see the data beating expectations because, of course, that will start to have some implications for the ECB monetary policy backdrop.
Okay, and then just to finish off with on the live front, dollar yen, that's sinking. I mean, we've gone sort of more risk off here, haven't we?
We have. I mean, it was interesting. We've been trading with sort of between the 100 and 200-day moving averages in the last couple of sessions, and in a sense, we're still generally confined by those parameters. It is a little bit risk off. We have seen some reasons to pair risk appetite in the course of the last 12 hours or so. I think the other variable that in play goes back in a sense to the commodity story and that oil price correction, because of course as the oil price falls, then inflationary expectations, inflationary pressures are dissipating, and so we're seeing yield spreads between treasuries and JGBs compress, and that is a reason why dollar yen is losing momentum.
Okay, and let's just go on to the traders' positions. It's always interesting to look over other people's shoulders and see where they are in the market at the moment. And let's say, I suppose, a surprise there, well, very short of euro sterling. So people determined that the euro will weaken. Doesn't look like it's going to happen, does it?
No, it doesn't. That's kind of an interesting scenario. I mean, we've been playing euro sterling from the long side over recent weeks. We did take a little bit of profit in the immediate aftermath of the election because we'd seen sort of a 4% gain on the trade. We've seen some degree of correction, but I think ultimately euro sterling is probably going to be going higher. I wouldn't necessarily want to be trading it much above 90 pence, but I think we could see a spike as high as 92. So I think, for me, euro sterling from the long side makes more sense.
Some sort of a bullish surprise is really possible there.
Well, I think in that cross, yes. I mean, I think it's more of a case that as we see the UK negotiations with Europe continue, I think the first round of those this week underline the fact that the UK's negotiation position is rather weaker than the government would have us believe, and I think accordingly we will see that reflected in terms of the valuation of sterling against the euro. Okay,
let's go on to the economic calendar to finish off. And here, well, we've got the Haldane speech, which is coming up in a few minutes. MPC member, obviously. All I can remember about him now is that he had a Michael Fish moment, or said that the Bank of England had a Michael Fish moment, but I'm not sure whether he's managed to retrieve his reputation after that. Then the SNB quarterly bulletin in New Zealand got interest rate statement and decision. So what's the highlight of the day for you?
Well, beyond the Queen's speech, which obviously is beyond that, I guess it's going to be fascinating to see how the RBN deal with their underlying inflationary expectations, because I think that's kind of interesting. Certainly some people are suggesting there may be a little bit of a subtle change in the language regarding the currency. I'm not so sure there will be at this particular juncture, but I think we're now getting to a scenario where markets are much more going to provide much more scrutiny of language from central banks, because we are getting rather closer to a number of central banks considering monetary tightening beyond just the Fed, as we've seen thus far. Okay, well, that's it for today's FX Street Currencies in Play, brought to you in association with Royal Financial Trading. Thanks to Jeremy Stretch, head of G10 FX at CIBC.